Hi everyone, welcome to Richfield Hybrid Learning. My name is Bongiko Singobo. I will be taking you through this module, Fundamentals of Accounting 511. In this module, you will learn financial literacy. You will also learn basic terms of accounting. You will also need to know why are we doing accounting and who are we doing it for. When you are doing accounting, you are doing to give a report. Who are we giving this report to? We are reporting to the users of accounting information. Why these users need to know the accounting information or the financial status of the organization? Because the main aim of starting any business is to make the profit. Now, what you need to do is to get a paper and a pen and enjoy accounting. The purpose of this module is to equip you with accounting knowledge and the skills on how to apply this knowledge in the business world. Once you learn how this works, you should be able to penetrate the financial world and the business world, and you should be able to start your own business and apply these skills. And this module is offered at NQF level 5 with 10 credit points. As we have mentioned, that for you to have thorough understanding, you need to read the prescribed textbook, and you can also read the recommended material. For this module, we have a prescribed textbook, which is the Fundamental Accounting 8th edition, which was published in 2019. And we also have the recommended material, which is Accounting and Introduction 13th edition, which was published in 2018. These books, you can find them also in our libraries or in any library if you are interested in using the book. On completion of this module, students should have basic practical and theoretical knowledge of the accounting and also the purpose of accounting and the functions of accounting, the nature of accounting theory, the financial position and the financial results of the enterprise. Also, you should be able to understand the double entry system as to how we are recording the transactions using the double entry system, the accounting cycle, the sequence that we are following to record the transactions, the inventory systems. There are different valuations of inventory, the adjustments, which will be the year-end accruals, the bank reconciliation, and also the internal controls that we are using in the business environment. For each semester, you will be required to complete 2 continuous assessment tests, 1 assignment, and 1 examination. When you are taking the 2 continuous assessment tests plus the assignment, that will contribute 40% towards your final mark. And when you take exam contributes 60% towards your final mark. So the 40% plus 60% will give you your final mark out of 100%. Okay, let us look at topic 1, the nature, the purpose, and the functions of bookkeeping and accounting. The purpose of this topic is to explain the objectives of accounting and also explain the accounting concepts revolving around accounting. And it will also assist us in identifying the users of financial information. Using this topic, we will give you the definition of accounting terms, and also we will go in detail with different types of reports that we need to prepare or that we need to complete in any accounting period. Also, after studying this topic, you should be able to determine the different types of users that we have in the accounting system. And you should also be able to understand or to define their needs for this financial information. We will also understand why is it important for the business to have these reports and why it is important to do accounting in any business operation. Okay, Let us start by looking at the term accounting. What is accounting? Accounting is a process of analyzing, summarizing, classifying, and recording the transaction. What is a transaction? What is it that you are analyzing and summarizing? We are referring to a transaction as an exchange of goods and services that involves money. Then, what is bookkeeping? Bookkeeping involves recording the transactions of the business on the day-to-day basis and also recording the information that is pertaining to the business environment. Therefore, bookkeeping is just one part of the accounting process. There are companies that are dealing with bookkeeping only. It is important for any business to appoint or to employ a bookkeeper so that all the transactions will be recorded in the books of the business. And the bookkeeper is responsible to record everything that is happening in the business, whether cash is moving or not. But the bookkeeper has a responsibility of recording all the transactions that are happening in the business environment. What is the purpose of accounting? The primary aim of accounting process is to give the report, and this report must be based on the financial results of a business for a particular period of time, and it must be based on the financial position at a particular point in time. And the primary objectives of accounting are to provide the information that is useful for decision making, that will be including the investment decisions and credit decisions. And also, it must be useful in assessing the amount and the timing of the future cash flows of the business. And the main aim of starting the business is to make a profit. One will ask a question, why accounting? As we have mentioned, that the primary aim of accounting is to give a report. The next question we need to ask ourselves is, who are we reporting to? We are reporting to the users of financial information. Who are these users exactly? These users are divided into two categories, that is internal and external users. What is the difference between the internal users and external users? Internal users include everyone that is involved in decision making within the business entity. These people, they make decisions based on what is happening inside the business. They will make decisions for the growth of the enterprise also. If we are referring to internal users, we are referring to people like the owners of the business. We are referring to people like the managers of the business. And also, we are referring to the employees of this business. And then we have, on another hand, the external users. Who falls under the external users? These are the people who are outside the business entity and who will use the information or who will use the accounting information to make their own decisions. So in other words, the internal users, they are coming within the business entity, whereas the external users, these are the people who are outside the business entity who need to use the information, the financial information that is provided by the business in order to make the decisions. Here we are referring to people like the suppliers, the banks, the customers, the investors, the potential investors, and also the tax authorities or government. Why will these people be interested in knowing the financial status of the business or the financial information of the business? It is simple. Suppliers will want to know if they give the business goods on credit, will they be able to pay the amount that they are owing them? Why the banks will be interested in knowing the financial status of the business is because whenever the business will be interested in taking a loan with the bank will need to assess the financial records in order to see if they will be able to pay back their loan with interest. Why the customers or the clients will be interested in knowing the financial status of the business? It's because they want to know if the business will still be able to continue in the near future. The business will still be able to provide them with the services in the near future. So they are assessing the going concern of the business. Why the investors will be interested in knowing the financial status of the organization? It's because they will want to know, or they will want to assess the risks and the returns if they were to invest their money in this business. Will we get back the returns, or we will just throw our money and make a loss? And why the tax authorities or government will be interested in knowing the financial status? They want to set the regulations relating to taxation so that the business will be paying tax according to the company's rate. They want to see if they are making enough profit and they are not understating their income or their profit in order to avoid tax. When we are reporting to the users of accounting information or financial information, we will report in the form of financial statements. And for us to prepare the financial statements that are accurate, we need to use the accounting principles, such as matching principle. This principle states that the expense should be reported in the same period in which the corresponding revenue is earned, not in the future period, not in the previous period, but they both must be recorded in the current period in which the revenue is earned. And then we have what is called accrual principle or accrual concept. With the accrual concept, it states that the elements of financial statements must be recognized when the transactions that are causing them occurs, not necessarily when cash is being paid or received. That is the accrual basis of accounting. And we have the going concern. What is the going concern? Is the ability of the enterprise to continue with its operations in the near future. Then, what it stipulates here under the accounting principles, it says the financial statements must be prepared in such a way that shows that the business will continue with its operations in the near future. We also have the prudence principle. Prudence principle stipulates that we must not overestimate the amount of revenue that is recognized in the current accounting period, and also we must not underestimate the amount of expenses. Same thing goes for assets and liabilities. You must not overestimate the amount of the assets that you have in the business, and do not underestimate the amount of liabilities that you have in your business. Then we have the materiality principle. The materiality principle states that the accounting standard can be ignored if the impact will be a small impact in the financial statements. But if it's gonna be a huge impact, you need to record that amount. You can't ignore it. For example, if we were to report and we realize that whatever that we omitted in the financial statements is not gonna change anything, we can omit it. We call that materiality principle, because you are ignoring the fact that it will have less impact in the financial statements. Then we have consistency principle. The consistency principle simply says once you adopt a certain accounting policy, carry on with it. Do not change it. Follow it consistently in future accounting periods and also from year to year so that we will be able to compare the financial statements of this organization. Don't change anything. Keep it consistent throughout the accounting periods. Then we will be able to compare your financial statements. There are more accounting principles that you will find in different accounting textbooks and also in different websites. For further information on accounting principles and concepts, please refer to the website that is provided below. Sometimes when you are looking at the old accounting books and looking at the previous question papers before GAAP principles were phased out, you will find the questions that are asking for students to prepare the financial statements in accordance with generally accepted accounting practice. But if you look at the most recent questions now, they are asking the students to prepare the financial statements in accordance with IFRS. What is the difference between GAAP and IFRS? GAAP stands for Generally Accepted Accounting Practice. It refers to a common set of accounting principles, standards, and procedures that is issued by Financial Accounting Standards Board, where we have International Financial Reporting Standards, which are the set of accounting procedures and accounting rules for financial statements of the companies that are intended to make it consistent, transparent, and also easily comparable around the world. The Accounting Practice Board was previously recognized as standard setter and began the process of harmonizing GAAP with IFRS in 2003. The Accounting Practice Board subsequently decided to adopt the IFRS standard as GAAP without amendment only up until May 2011, but also issued additional guidance in the form of interpretation of SA GAAP. Under the changes, GAAP ceased to apply in respect of financial years commencing after the 1st of December 2012, and the entities that were applying GAAP were now required to apply IFRS standard. The IFRS are issued by International Accounting Standards Board. In South Africa, we got quite a few forms of ownership with the profit motive. The aim of starting these businesses is to make the profits. These forms of ownership will be your sole trader, partnership, close corporation, companies. Sole trader is the form of ownership that is owned and managed by one person. Then you have partnership, a form of ownership that is owned by two or more people. And these people must have a mutual agreement. There must be an agreement between them that they are agreeing to start the business. Their agreement is called partnership agreement. Then we have a close corporation, a form of ownership that is formed by one or more members, but not exceeding 10 members. Then under the companies, we have a private company, the PTY Ltd, at the end of the name of the company. This company can be owned by 1 to 50 shareholders, whereas we have the public company on another side that can be formed by the minimum of 7 members, but the maximum number cannot be restricted because it is determined by the number of shares that are issued. At the end of the accounting period, the business is required to present the financial statements. In terms of International Accounting Standards 1, a complete set of financial statements will include the statement of financial position, which is also known as balance sheet, the statement of comprehensive income, which is also known as income statement, the statement of changes in equity, the statement of cash flow, and also the notes to the financial statements and the notes that are comprising of the accounting policies. What the statement of position does, or the balance sheet does, it shows the position of the business. It shows the financial position of the business. What does the statement of profit and loss and comprehensive income show? It shows the financial performance of the business. And then we have the statement of changes in equity. What does it show? It shows the changes in whatever that is contributed by the owner, including the retaining income that was in the business at the end of each accounting period. That's why it is referred to as the net worth of the business. Equity is referred to net worth of the business. Therefore, the statement of changes in equity shows the net worth of the organization. Then we have the statement of cash flow. What it shows the cash movement, whether inwards or outwards of the business. And also, we have the notes to the financial statements. These notes are there to support all the above financial statements when there are accounting policies that need to be cleared. For these financial statements to be accurate, they must consist of what is called qualitative characteristics of the financial statements, which include understandability, relevance, reliability, consistency, and comparability. What happens when you are presenting the financial statements? It states that the information that is provided in the financial statements must be understandable to all the users of the accounting information. And also, information must be relevant to the users of accounting information in order for them to make decisions that are wise for the business. It also carries on and says the information in the financial statements must be reliable in such a way that it is free from errors. It does not have material errors. It must be neutral also. It must be complete and it must be prudent. It goes on and says, for the financial statements to be consistent and comparable, you must adapt to one accounting principle and follow it through. When you are following it through, what does that mean? You should be able to compare the financial statements from year to year or from one accounting period to another. If I'm taking the financial statements, I should be able to follow through on what has been happening throughout this business. If you are using one accounting system, it must be the same throughout. Therefore, we will say these financial statements, they have what we call qualitative characteristics of the financial statements. When doing these financial statements, we need to remember the important aspect of the financial statements is referred to as elements of financial statements, which is asset, liability, owner's equity, income, and expenses. What is an asset? An asset is a resource that is controlled by the business as a result of a past event from which future economic benefits are expected to flow into the business. One will say assets are possessions of the business, which is true. Assets are divided into two. We have non-current assets and current assets. The non-current assets are those assets that can be used by the business for more than one accounting period or for the long term. Then we have current assets. Those assets that can be converted into cash within a short period of time. Non-current assets are also divided into two, which is tangible assets and intangible assets. Tangible assets are those assets with physical existence. There is physical nature of these assets. Assets like land and buildings, motor vehicles, and equipment. It will form part of your fixed assets or of your tangible assets. On another hand, we have intangible assets, those assets without a physical existence, such as financial assets like fixed deposit accounts or investments. Then the current assets, as we said, we are looking at things that can be converted into cash within a short period of time, which will include your inventory, your trade debtors or trade and other receivables, which will include cash at the bank or cash and cash equivalents. Then we have liability. What is a liability? A liability is a present obligation. Remember, not the future commitment, but a present obligation of the enterprise, the settlement of which is expected to result in an outflow of economic benefits. The liabilities are also divided into two. We have the non-current liabilities and the current liabilities. The non-current liabilities are those liabilities that are payable over a long period of time. And the current liabilities are those liabilities that are payable over a short period of time. Then we have equity. Equity is the residual interest in the asset after deducting all your liabilities. In other words, you take what you own minus what you owe. That will give you your equity. That's why it is also referred to as the net worth of the business. Equity is also referred to as the net worth of the business. Then we have income and expenses, which indirectly affect the equity. What is an income? An income is an increase in economic benefits during the accounting period in the form of inflows that will result to an increase in equity and equity participants. Then what is an expense? An expense is a decrease in economic benefits during the accounting period that is in the form of outflows that will result to a decrease in equity and the equity participants. Now that we have covered basic concepts and principles of accounting, you should be able to do the following review questions. Define the term accounting, discuss the GAAP and IFRS principle, discuss the qualitative characteristics of the financial statements, and also distinguish between the internal and external users of accounting information. I'm sure with the information that you have acquired from the beginning of this topic, you should be able to relate and you should be able to answer all these questions without any problem. I hope everything that we explained in this topic you will be able to apply in the following topics, because accounting is a continuation from one topic to another. You can't say that we have completed topic 1 now, you forget about what we did in topic 1. Whatever that we spoke about in topic 1 will still be recurring in topic 2 and the rest of the topics. Thank you.